Hello, and welcome to another episode of IJS Speaks. This is your neighborhood financial economist, Katie Mark. Today is May 22nd, 2021. It is 1:57 p.m. Eastern Standard Time. Today, I wanted to start off by talking about cross-asset correlations. The most common one that most investors think about or familiar with is the relationship between stocks and bonds, where typically they move in opposite directions or are inversely correlated. So what you'll tend to see is as bond prices go up, stock prices tend to fall. The concept behind that is risk versus safety. When investors have more risk appetite, they sell the safety in bonds and they buy stocks. And when they're more risk averse, they sell the risk in stocks and buy safety in bonds. That's the whole concept behind your 60-40, or in some cases 60-30 and 10, which is your 60% stocks, 30% bonds, and 10% cash. Your basic portfolio, generic investment portfolio. Now, what I've been noticing recently, when we see stocks trading up, we typically tend to see bonds, especially the 10-year treasury, US 10-year treasury, trading up as well. And when stocks are down, you also see a similar sell-off in bonds, more specifically the US 10-year treasury. That market action completely throws the concepts that your generic stock bond portfolio is based on. Now, more than likely it has something to do with the level of involvement that the Federal Reserve has in the Treasury market. The Federal Reserve and its ultra-accommodative monetary policy, in some cases, is buying hundreds of billions of dollars worth of bonds every month, increasing their balance sheet, their holdings, by $1 trillion plus every year, and they've been doing that for several years. They've basically become an outsized participant in the US Treasury market. And as a result, I do think we're seeing distortions in the feedback that investors can receive from treasury prices and their corresponding yields. Another typical relationship that investors have come to expect is an inverse relationship with commodities and the dollar, specifically oil, and in some cases gold as well. So typically, when you have commodities priced in dollars, as the dollar appreciates or gets stronger, the prices on those commodities tend to fall. And vice versa, as the dollar depreciates or gets weaker, the prices on those commodities tend to increase. The relationship with the dollar and gold is one that has been in flux in recent. As I monitor the correlations to help me set my trades, sometimes on an intra-week basis, I will notice that the dollar and gold are trading together or are positively correlated. And other times I notice that they're negatively correlated, and there are a few times when I'll look at the correlations and the relationship seems to be uncorrelated. So they have very little to no correlation whatsoever. Similarly with oil, there have been times where I've looked at the correlation with the dollar and oil prices, and they are positively correlated. So the dollar goes up, oil goes up just as well. Other times, most times, they're typically negatively correlated. So strengthening dollar usually means lower oil prices, and a weakening dollar typically means higher oil prices. A correlation relationship that I've observed through my trading is with oil and soft commodities, or the grains. So corn, soybean, and wheat. More specifically, corn and soybean, but wheat tends to also move in solidarity with the rest of the soft commodity complex. So if you see a day that corn and soybeans are up, wheat may tend to be up, not quite as much, but it will be up. At the same time, you see a day where corn and soybean prices are down, wheat will tend to be down, maybe not as much, but it will also tend to be down as well. So across that complex, they tend to move in solidarity. But of recent, I've noticed a positive correlation between the grains and oil. This came into play in the last trading week as I didn't have any exposure to oil, but I did have exposure to the grains, specifically corn and wheat. I was comfortable going short the grains because oil prices were selling off, and there was news about sanctions possibly being lifted against Iran as they're starting to negotiate again with the Biden administration, which basically meant that they can bring their supply of oil back into the mainstream market and not just sell it on the black market, for instance. And as you add to the supply, demand being the same, typically will push the price down. So in the previous trading week, not the one that just ended, but the one before, I closed out my long oil positions, looking at a longer term chart, looking at a medium term chart, looking at 3 months worth of data. The chart was signaling weakness in oil. I still think that $60 will pose as a support level. So oil will more than likely trade down to about $60 a barrel and consolidate. If it breaks below that, then we're looking at a lower target, which I'll get to in the forecast portion of the podcast. But if it holds at that $60 level, it consolidates, it can then get back on trend moving higher. So, cross-asset correlations, not necessarily something that's talked about, but it is worth considering and worth monitoring because they do change over time, especially when you're trading or investing across multiple asset classes. You can improve your timing or at least get more feedback in the assets that you're trading by looking at correlations with other asset classes and looking at how moves in one asset class, which may lead or lag another, can give you hints into or give you insight into something that you're otherwise trading. Moving past that, let's look at the trade book. So this week that just ended, it wasn't necessarily the best week for me. I actually lost a decent amount of money. I had some winning trades. I had more losing trades. Net effect, I lost money this week. Let's start with the winning trades. So again, looking at my medium-term charts and keeping my long-term charts in mind for context, I've been looking at the dollar index, and like I've mentioned in previous podcasts, I've seen the dollar index get to around that 90 to 89, 88 level several times, consolidate and reverse. So starting this trading week that just ended, I saw the dollar again getting to that level, and I started positioning myself for the reversal. The exposure against the dollar that I've been taking has been through the Australian dollar, the Great British Pound, and the Euro. So in anticipation of the dollar strengthening, I go short those currencies with futures contracts. And of course, the different economies associated with the currencies have their different macro fundamentals that influence how the currencies move on any given day or in any given trading session. But overall, they are following a similar medium-term to longer-term trend. It's just that some are a little bit further along than others, but in the medium term, they all typically tend to move with some degree of consistency in relation to the dollar index, which is again a trade weighted basket or an average of currencies. So the dollar index may do one thing, but depending on how heavily weighted the currency that I'm looking at comparing to the dollar is in the actual calculation of the index, it may not respond as immediately or as strong as the dollar index is moving or when it's moving. But over time, they tend to move in conjunction with the index. The Aussie in particular, I was able to lean in on that short Aussie trade because as a commodity exporter, weakness in the commodities markets, specifically looking at the grains, looking at oil, not so much gold, which has maintained a steady march up, but other commodities have been slowing down. You see the same in the metals, the mined metals, which Australia exports a lot of, your iron ore, your coppers. The weakness in those commodity prices has led to weakness in demand for the Australian dollar. So I was actually able to double down on my positions in the Australian dollar, trade the extra exposure intraday. So looking at shorter term chart patterns, the Australian dollar was poised for an acceleration lower. I doubled up on my positions, followed the trade as the day's trading session played out, exited on the extra exposure towards the end of the trading day, and was able to capture some profits. The pound and the euro weren't necessarily as vigorous in their moves, so I didn't feel the need to commit the extra capital to those currencies or those currency futures. And also with the volatility that the rest of the market was experiencing, my broker tends to adjust my margin requirements. So at one point I actually had to sell some equities just to cover my additional margin requirement because of the volatility that was being experienced in the market. So I didn't necessarily want to commit extra margin to currencies that may or may not have been poised to move versus looking at one that I was getting several clear signals that it was poised to move lower in line with my analysis. So I decided to add the extra exposure in the Aussie versus the euro and the pound, which I have my base exposure and I'm basically just letting those mature as the next couple trading weeks play out. And again, looking at my shorter term charts, if at any point any of them looks specifically poised for a move, I will lean in on that trade, add more exposure, and then lean off or take exposure off that trade as the intraday trade plays out. So that was on the winning side. On the losing side, the volatility in the rest of the markets made it very difficult for trading. We'll start with the grains. To start off the week, I was short corn, wheat, and soybeans. Very early in the week, we had a bout of volatility. I saw a huge move against me on those positions, added to the increased margin requirements. I made the decision to realize losses on the grains and focus the margin in the account on other markets that I thought had a little bit clearer picture. Towards the end of the week, volatility settled down, the margin requirements changed. I was able to redeploy the extra margin back into the grains, this time just looking at wheat and corn. and they were also moving in line with oil. Oil started moving lower, but as we got into Friday and relatively late in the session on Friday at that, I saw a spike upwards in the price of oil, which of course caused the grain commodities to spike up as well. And my exposure to those commodities, I used options on the futures contracts. So just trying to limit my downside to the options premiums that I paid versus more exposure in an outright futures position, especially with the changes in margin requirement as volatility tends to spike and drop. So the options that I had basically expired worthless with a last minute rise in oil, which led to a last minute rise in the grain prices. Similarly with the 10-year treasury, again, using options on the futures contract. In the beginning of the week, we saw a drop in stock prices. So the S&P 500. It corresponded with a drop in the 10-year treasury price and a rise in yield. I had the exposure going short the 10-year treasury, again for macro fundamental reasons, with the position of the Fed and monetary policy versus the type of inflation data that we're getting out of the economy. But with that last minute rally in stocks, also saw a last minute rally in the 10-year treasury. Prices went higher, yields went lower. Those options expired worthless. And lastly, for my medium to longer term inflation exposure, I look at blockchain as an emerging technology that is here to stay. In what form? More specifically, in the form of cryptocurrencies, that's debatable. But the technology itself, I think, is going to be a permanent fixture going forward. It's just a matter of businesses, governments, individuals finding new and more ingenious ways to utilize it, but I don't think it's necessarily going anywhere. I have exposure through an ETF because it's more of a longer term play, more of a position that I'm building in it versus a shorter term trade. So I'm trying to take the time element out of the exposure. With options, with futures, they all have expiration dates, so there's a bit of a time element factored into the decision making. With an outright equity position, in theory, you can hold it forever. While there have been several news releases, comments, statements in the past couple weeks about Bitcoin, which is the most infamous application of blockchain technology, whether it be from Elon Musk and Tesla or from the Chinese government, there's just been a lot of negative commentary about Bitcoin in particular, which has led to a bit of a correction in the price. I don't want to necessarily call it a crash because Bitcoin is so volatile that even a 30% move down is not necessarily a crash based on how volatile the asset class is. But with a bit of a correction, which of course my equity position has been losing value, it's a longer term position, so it is still worth mentioning that the position has been taking money off my books simply because of the negative news headlines associated with Bitcoin in particular. Now we can move on to the dashboard. Start with gold. As I mentioned earlier, gold has been on a steady march higher. It hasn't necessarily corresponded with a march lower in the dollar, over the duration of gold's march higher, because there have been times when the dollar was up, gold wouldn't be down. Other times that the dollar's down, gold is up. The relationship between gold and the dollar, that cross-asset correlation, tends to shift and has been shifting more rapidly in recent trading sessions. But with the dollar on a medium and a longer term basis looking like it's consolidating and reversing, it will be interesting to see that if we get a sustained move in the dollar higher, how the gold market responds to that. The regression curve ribbon is horizontal, and this is looking back over 5 trading days. The price of gold has been oscillating around the ribbon. As of close, it was sitting in the middle of the ribbon. So gold has basically been trading sideways. The regression curve ribbon is demonstrating that. My pivot indicator is below the price, signaling support, but it also doesn't have a very steep slope. It is effectively marking sideways movement. Support, but sideways movement. My regression slope measuring momentum, it's flat. It's oscillating around the 0 line, which basically says to me that in the past week, gold has had no upward or downward momentum. It's just been trading sideways. My linear regression slope measuring trend is positive, but barely. And from the start of the trading week to the end of the trading week has gotten much less positive. So the trend is also moving towards flat. So the dashboard, in all honesty, isn't signaling any direction in gold. From a trading standpoint, I can highlight recent highs, highlight recent lows, and look to trade a sideways market. From an option standpoint, condors and butterflies, they're good to play those where you're basically looking to collect premiums above and below the market trading range. And if the market price stays within that range, you get to keep the premiums. But for the most part, no clear sense of direction on gold in the short term based on the dashboard. 10-year Treasury is highlighting a similar story, which again, there is that relationship between gold and the 10-year Treasury, which I've noticed looking at short, medium, and long-term charts. They do have a very similar price action profile, even though intraday or intra-week, one may be up a little bit more than the other or down a little bit more than the other, but their overall price action profile, the picture that they paint, is very similar. And I do think it's because of the relationship that they both have with inflation and inflation expectations. But the price on the 10-year Treasury, it's sitting inside of its regression curve ribbon, and the ribbon itself has just been oscillating. So the price has been oscillating around the ribbon, and the ribbon has been oscillating around the price, basically going nowhere all week. My pivot indicator has been oscillating from above the price to below the price, signaling both support and resistance intra-week. In other words, no clear picture. My linear regression slope, which measures momentum, oscillating from positive to negative around the 0 line. No clear sense of momentum up or down. Similarly with the trend, oscillating from positive to negative around the 0 line, signaling no clear sense of trend in either direction. So both the 10-year Treasury and gold on an intra-week basis are flashing flat trading. If you can highlight your upper bound and lower bound of this sideways price action, you can look at different option strategies whether it's basically buying outright puts at the top, outright calls at the bottom, or utilizing a butterfly or a condor strategy, which again gives you the ability to collect premiums outside of the trading range. And as long as the price stays within the trading range at expiration, you get to collect the premiums on both sides, and you get to profit that way from a sideways market. Or you can trade intraday as the price oscillates back and forth, taking on exposure in either direction and looking for short-term or intraday reversal patterns in the price and switching your exposure from long to short and back as you see those price patterns show up in your charts. The dollar index has a little bit clearer of a picture. So at the beginning or the first half of the week, the linear regression curve ribbon was moving down at a 90-degree angle. So the dollar was falling, and the price itself was trading very neatly inside of the ribbon. As we got to the middle of the week, the regression curve ribbon started oscillating, and the price started oscillating around that, which on the longer term charts would have highlighted consolidation. My pivot indicator in the beginning of the week was above the price and sloping down, so highlighting resistance as the price moved lower. As you got into the middle and later half of the week, pivot indicator switched to below the price, signaling support. As of close, the price was sitting above the regression curve ribbon, which to me signals that the dollar was accelerating higher. My linear regression slope measuring momentum was negative through the first half of the week, went positive early on the Wednesday session, and has been oscillating above positive and negative towards the latter half of the week. Ended the week positive, which again highlights the consolidation, but towards the end we see that the momentum was positive, which lines up with the acceleration higher as the price moves above its linear regression curve ribbon. My linear regression slope measuring trend, it's a little bit smoother. It was falling all through the first half of the week, started getting less negative into the second half of the week, and by close on Friday, it just went positive, which signals to me that the trend went from a downward trend, it consolidated as the indicator got less negative, and went positive, which indicates that the trend is turning positive on the dollar. So that leads me to be a little bit more confident in my currency positions, looking at a long dollar play by shorting the Aussie, the Euro, and the Pound. At least into the upcoming trading week anyway. Then we have the S&P. So on the week, from where the S&P started to where it closed, it's basically flat. Started at around 4150, ended at around 4150. So from the first half of the week, it was falling down to that longer term target of 4050, similarly to what it did last week, and then it reversed into the second half of the week, and more so into overnight Thursday into Friday. Its pivot indicator has been oscillating from above the price to below the price and back. So it's been highlighting support, then resistance and support, which basically tells me that the price is moving sideways. There's no clear sense of whether the price is accelerating higher or lower. Similarly with the regression curve ribbon, it was downward sloping, turned sharply, and now it's upward sloping, and the price has just been oscillating around that. At close on Friday, however, the price was below the regression curve ribbon. So, unless we see a sharp move higher in the beginning of the trading session coming up, we're probably going to see the price on the S&P once again accelerate lower maybe, as it's done in the last 2 trading weeks, accelerate lower in the first half of the week and then rebound in the latter half of the week. My linear regression slope indicator measuring momentum was positive, but sloping getting less positive, went negative mid-Tuesday trading session. It bottomed mid-Wednesday and turned around and went positive by overnight Wednesday into Thursday, and by the close of Friday it was back at the zero line, getting less positive. Looks like if the price action continues, the momentum may go negative once again, which that oscillation back and forth between positive and negative just tells me that there's no clear sense of direction in terms of momentum, more sideways trading. The linear regression slope measuring trend, similar action, was positive, then went negative, and towards the close on Friday went positive again. We'll see if it holds up, but if recent trading is any indication of what to expect, it's more than likely going to drop negative again and then go positive. The thing worth noting though, and this is where the longer term charts come into play, is the context that they bring. So for the past couple weeks, the S&P has been touching a long-term support level, which is fine because it seems like it's establishing that price level as support. The only problem is it's not making any new highs, so it's not breaking out to the upside to convince me that it's worth taking on exposure towards the upside. If the price breaks below that longer term support level, then we're looking at a drop or further drop in the S&P 500. Now, listening to the type of analyst calls that are out there, I've heard calls for 4,300 on the S&P end of year. I've heard calls for 4,600 on the S&P end of year, but I've also heard calls for 3,900 on the S&P end of year, which happens to be the next support level if the 4,050 level breaks as support. So, at least somewhere out there, there are analysts or a handful of analysts that think that the market is peaked for this year and will probably trade sideways to lower as the year progresses. Keep in mind, we're in May. And lastly, we'll look at crude oil. First half of the week, crude oil was basically trading flat. Then it took a decided move lower, middle of the week. Prices plateaued, like I said, on Friday. So they looked like they started consolidating on Friday. And then we had that sharp move upwards, which undid my commodities, my grains exposure. Took losses because of that. So linear regression curve ribbon. First half of the week, first trading session, it was trending slightly up. It peaked somewhere early in the Tuesday session and started moving lower. And the price was, during Tuesday to Thursday, the price was trading below the linear regression curve ribbon, which meant that the price was accelerating lower. My pivot indicator, which was oscillating from support to resistance and back, coming out of the previous week's trading session and into this week's that just ended, so Monday to Tuesday, it was oscillating back and forth from support to resistance, went clearly above the price starting on Tuesday and stayed above it all through the end of the week. So even through the move higher on Friday, the pivot indicator is still above the price of crude oil, which that indicator by itself is signaling that there is resistance and the price would need to break through that resistance level before it can continue higher. If not, we can just expect more downward price movement. Now, the move higher on Friday did take the price of crude oil above its regression curve ribbon, which signifies an acceleration higher. But between the regression curve ribbon and the pivot indicator, we're looking at an acceleration higher into resistance. Linear regression slope measuring momentum, it was negative all through the week, went positive late on Friday, which again corresponding with that sharp move higher in price. The linear regression slope measuring trend has been negative since mid-Wednesday, and it looks like it started going less negative on Friday, but it's still well into negative territory. And that's it for the dashboard. Now we can move on to the forecast portion of the podcast. So, keeping things in order of the dashboard, we'll start with gold. On a longer term chart, gold looks like it has found support. So it looked like it found support about the 1700 level, which has historically been a consolidation level. And it also broke out of the top of its linear regression curve ribbon on a longer term basis. So the price is accelerating higher. With the downward channel that I drew on the chart, it is still flirting with that channel. So I don't have a clear indication of a breakout, but at least the price accelerating above its linear regression ribbon lets me know that gold has a little bit of strength to the upside. On Friday, it closed at about 18,081. A nice round number target is $2,000 an ounce. So if the steady march higher continues with gold, we can see $2,000 an ounce gold before the year is over. But again, it will be interesting to see if we get a bit of a steady move higher in the dollar, how the gold market responds to that, or if that relationship that's typically inverse between the dollar and the gold breaks down and they spend some time moving in the same direction. The 10-year treasury still looks like it has more downside than upside from where it is. It is at a level that it consolidated on previous trading timeframes. We could just be looking at a period of consolidation around these levels. So the 1.55 to about 1.70% yield on the treasury looks like a range within which the price can consolidate. If it breaks below that, we're looking at about 126 and a quarter on the 10-year treasury, the price. Not sure what type of yield that corresponds to, but probably closer to 2%. It's at the bottom of its linear regression curve ribbon, so it's using the regression curve ribbon as resistance, which also signals that the price is accelerating lower. So despite this week's trading outcome with the 10-year treasury, and if the cross-asset correlation holds between 10-year treasuries and stocks, we really could be in store for a move lower in stocks if bonds are going to move lower and they move together. Also lends credence to the analysts that are saying that we could expect 3,900 on the S&P by end of year. So putting the cross-asset correlation between stocks and bonds in line with other analyst calls, as well as seeing the price on the S&P keep flirting with its support level, makes me again a little bit hesitant about adding exposure towards stocks. So maybe there is some credence to the sell in May and go away. It just didn't necessarily start at the very beginning of May. But we'll see how it plays out as the quarter progresses and the summer progresses. Then there's the dollar index. So, the dollar index, the price on the dollar index is below its regression curve ribbon on a longer term chart, which signals that the price is accelerating lower. However, it is at a level at which it has consolidated several points in time, and I think it's once again demonstrating a consolidation. From a candle pattern standpoint, it looks like it's building a double bottom, but this is with monthly candles, so we're not going to get confirmation on this for at least a week. If the consolidation holds, the price reverses, the first target would be about 94 on the dollar index, which would be around the level where it bumps up against its regression curve ribbon, the lower bound on the ribbon. If it breaks through, we can easily see 96 as the new level of resistance, and if it breaks through that, we're looking at above 100, so about 101 on the dollar index. So like I said, it would be interesting to see how a sustained move higher in the dollar affects the gold market as well as the oil market and the rest of the commodity complex, because they're typically priced in dollars, and a strengthening dollar usually means weakening or falling commodity prices. We've got stocks. Looking at the S&P 500 in particular, the 4,050 price level looks like it's being held as a support level, but we won't get final confirmation again because these are monthly candles until the end of the month, so about another week and a half or so. But if the 4,050 level holds, then we're looking at resuming a move higher with a target of about 4,300 at the 78.6. If that breaks down, then we're looking at a move lower to about 3,900 on the S&P as its new support. And of course, a move lower in the S&P would correspond with a move lower in bonds, which makes more sense for the macro fundamentals, as well as a move lower in the S&P would correspond with rising interest rates as the discount rates used to discount future cash flows goes up. The present value of those future cash flows goes down, which is the share price. And then lastly, we have oil. Oil is still sitting above its linear regression curve ribbon, which demonstrates that the price is accelerating higher. However, it has been consolidating, and it does look like oil may be retesting that $60 a barrel level as support. If that holds, then it resumes its march higher to about, let's call it $77 a barrel, pushing $80 a barrel. If the $60 a barrel floor does not hold, however, oil would probably start moving down towards about $40 a barrel, which that's a level that it consolidated at on several points in recent trading history. It would first, however, have to break through its regression curve, but that would only highlight an acceleration in the price move lower. And then, of course, there are the grains. Looking at what could possibly happen with oil and the dollar, if the dollar accelerates higher and oil holds that inverse relationship, then we can see oil prices moving lower and taking the grains lower with them. So a move up in the dollar would more than likely stem the inflation fears that are being drummed up as we've seen commodity prices accelerating higher. If the inflation fears are being quelled, then we may see stock prices extend higher, because then investors will assume that the Fed will push back its theoretical start date for tapering and tightening monetary policy. And if the Fed is pushing back on its start date for tightening monetary policy, stocks move higher. We could also see a move higher in bonds and a move lower in yields. So if the dollar moves higher, we're basically seeing an extension of easy money in the United States because inflation fears should be quieted. If the floor breaks on the dollar moves lower, then we should see higher grains, higher commodities, higher gold, theoretically. And if those stoke inflation fears, then it puts the Fed that much closer to having to tighten monetary policy, and that would push stocks lower and push bonds lower. So a lot hinging on the dollar right now. So in today's episode, as always, I talked about technical analysis. I looked at candle patterns, I looked at technical indicators, and I do look at chart patterns. All part of technical analysis, which as a trader is an indispensable skill to have, to be able to look at a chart and gather as much information as you can. It helps with your timing, it helps with setting targets, it makes you an overall more profitable trader. For those that want to learn more about technical analysis, and in particular the type of analysis that I do, you can visit my site at rtn.education. That's rtn.education in your browser. Hit enter, and you can sign up for classes where you can work with me personally to learn about technical analysis, or you can go to my business website, runthenumbers.biz. That's RUNTHENUMBERS.biz in your browser. And you can look at the types of consulting services that I offer to more experienced traders, from the economic side, looking at the macro fundamentals and how they apply to your trading decisions, or from the finance side, looking at the markets, cross-asset correlations, changes in correlations, and how those can apply to your trading and your portfolio. And on that note, this is your neighborhood financial economist, Katie Mark. When in doubt, take profits.